I think now we've addressed two important asset classes. We've addressed equities, where the listed equities, where we've had a haircut of about 500 billion.
Correct.
And derivatives have performed well in this environment. Let's turn our attention to an important asset class that is widely held, which is the fixed income and money market. What do you think, as an economist, of how the yield curve is likely to behave in this environment?
Okay, it's an interesting question. Interesting in the sense that the Kenyan yield curve has almost a mind of its own. Traditionally, we've had yield curves driven by expectations around what central banks are doing, what governments are likely to do. But I think for Kenya, we find ourselves in a sort of unique position in that we still sort of have the lagged effects of the rate cap between 2016 and 2019, which still which has still distorted the yield curve and expectations therein substantially. But that said, for now, it looks like, yes, we're still seeing some moderate downward pressure on the short end. But of course, the expectation on the longer end is rising. So you're literally looking at a fairly steep curve, right? Will this be sustained?
Why downward pressure on the short end?
Because banks, which are the biggest player, 55% of our domestic debt is held by commercial banks, are extremely liquid. They're extremely liquid and risk averse right now. Yes. So any liquidity they have, they're actually preferring to shift it to government securities other than any other asset. Assets, which in this case, the biggest one is lending, right? So liquidity is quite high. Overnight rates have stuck below 5% for the longest time, let's say throughout this year. At the same time, the central bank is still mopping up to 75 billion last week from market in excess liquidity. So if banks are not lending, the only other viable alternative has been government securities. And the supply is not as much as how much, the demand we're seeing from commercial banks. And of course, with whatever's happening on the equity side, anyone is looking to perhaps rebalance their portfolio in favor of more government security, because you still have some positive yield on that end. So that complicates things a bit. As much as, yes, our fiscal space is quite narrow, and if we have to increase spending, which we will have to in this space, already government has taken a cut on revenues just to provide incentive for businesses and individuals to keep up spending. So you're looking at a pretty much wider deficit. I think from our initial assessment, we think that if government was to sustain or rather maintain spending at about 2.8 trillion, then you're potentially looking at double-digit fiscal deficit.
Fiscal deficit.
Yes.
Yeah.
And how do you fund that?
Yes.
Already before the pandemic, we're already having serious fiscal imbalances. Right?
And that puts pressure on the yield curve.
Exactly. Ideally, that should put pressure on the yield curve, and that's why I'm saying our yield curve is it's kind of in a unique situation where, as much as whatever is happening would demand for a higher premium on the sovereign, the demand is so much that you sort of have the pressure pretty much contained for now. But ideally, I think we're likely to see some pressure upward. Why? Because with the pandemic and the need for banks to restructure their loan facility, their liquidity is going to take a hit. Which means we again can't invest so much in government securities. Unless you give me a very good yield to give you that money, then I'm likely to just prefer to hold cash. And I think it's coming through. You saw the T-bill subscription last week. I think there's a general shift towards cash because we are not certain how this is going to evolve. So we need that liquidity.
Yes. You forgo the interest
you'd rather have that liquidity,
then
excess of it earning you pretty much nothing than having to
lock
fund
in.
it. If you lock in and you have to now come to the market to fund it, or to the central bank, I think discounting is still at CBR plus 6%. CBR is at 8, it's 14%. It's pretty expensive for these circumstances, under the current circumstances. So yes, we're likely to see the premium now on the sovereign start to rise. I think the initial estimates from the supplementary budget suggest that government will be looking to borrow an additional about 85-90 billion from the market this year, which means it's between now, in the next 2 months.
Additional?
Yes. 90 billion from the market. So they've increased their debt target to about 390 billion. From 300 billion. So, and they're already at 275. So actually it means they'll probably have to borrow like 150 billion in new borrowing in this period. So if you add that to whatever they need to redeem, which I think should be about maybe just a short of 300 billion, then certainly we're going to have competition for the available liquidity up until June. And that ideally should drive the curve higher.
And I mean, it's not possible to discuss the interest rate direction without talking about the strength of the currency, local currency.
Yes.
The exchange rate.
That's true.
What do you think will be the general direction of the local currency? And how does that reflect on the interest rates?
Okay. For the longest time, I think a lot of us have gotten it wrong on the exchange rate. Why? Because I think over the last couple of years, we've had central bank come in very strongly to defend the currency, to prevent or rather limit the noise on the currency. Right? And so while we've seen significant moves on emerging and frontier market currencies, we haven't seen the currencies, especially not just in Kenya, but I think Tanzania as well. Uganda has been almost also contained for now. But central banks generally have played a very big role in just maintaining that stability. So the initial knee-jerk reaction has been quite evident when we see the currency move to about 108. And in my view, I think that was like us pricing in the worst case scenario, considering what was happening outside other countries, right? And so I'm not as pessimistic on where we go from now on the currency as you naturally would be. So I think we're still likely to hold within the 106, 107 levels to year end on the worst case scenario.
Worst case scenario.
No, actually, let me say best case. Worst case, because we still don't know how this evolves, it could be worse, right? But that said, the central bank is still pretty much in the market to try and cushion, of course, the currency, prevent much depreciation. They still have some fair level of reserves, but I mean, that goes without saying, like we still, with the whole uncertainty still, we need those cushions because we still don't know how this evolves. Right? So and I guess that's why they've not aggressively tried to defend the currency so far, like you would naturally expect. But that said, there's another angle to it, which perhaps is why central bank has also aggressively try to make sure we don't see move to the 117 that the IMF had indicated a while back, because our debt position will become quite vulnerable. I mean, our debt position will rise significantly in the event that you have your currency depreciating markedly. I won't worry much about inflation because we are not importing as much currently. And either way, we still have some reprieve from oil prices, and I think just the general slow demand in most countries means prices will not rise as fast, right? But the implication any market depreciation will have on the currency right now, I think we try to run a simulation and a 1% depreciation in the currency could result in a 0.4 basis points increase in the public debt.
Yeah.
So ideally, if we had to move to 117, then we are talking about 70% debt to GDP ratio.
Yeah.
And that for
That
us
would
is
be
unsustainable.
it's a
Already
crisis.
already we're struggling to manage our debt currently.
Yeah.
The debt service is so much, and you have the dollar appreciating globally, which makes it worse.
Yeah.
Refinancing is also not an option because now interest rate spreads have widened between us, our sovereigns, and of course the US dollar. And so we really need to manage that position quite strongly. And that could also speak to just how the currency evolves going forward.